I am Arath, and that's my world.
Your alarm goes off. Most people hit snooze. He doesn't. Because somewhere on the other side of the world, the Tokyo Stock Exchange just opened, and he needs to know what happened. This is the life of a stock market trader, and it is nothing like what you see in the movies. The real version is more interesting, more psychological, and far more brutal. Today, we are going to follow a trader through every single hour of their day, from the moment the alarm goes off to the moment they finally close their last position. Let's go. The pre-market routine begins. Before a trader ever places a single trade, they spend 2 hours just reading earnings reports, Federal Reserve statements, overnight news from Asia and Europe. Every piece of information is a clue. Here's something most people don't understand about trading. By the time the market opens, the best traders already know what they're going to do. They have a plan A, a plan B, and a plan C, because the market doesn't care about your feelings. 30 minutes to open. The trader checks their watch list one last time. This is where the psychological game begins, because every trader on the planet is looking at the same data, doing the same analysis. The edge, the thing that separates profitable traders from everyone else, is not the data. It's what they do with their emotions when the data is wrong, and that edge is invisible on any chart. The opening bell. The first 30 minutes of trading are called the amateur hour by professionals. Prices are volatile, irrational, driven by overnight orders and emotional retail traders. Smart money watches. It doesn't act yet. Here is a fact that will change how you think about the stock market. Studies show that 70 to 80% of daily trading volume in the first 30 minutes comes from algorithms, not humans. You are not competing against other people. You are competing against machines. The dust settles. This is when our trader finally starts looking for entries, not because the clock says so, but because the chart has started to tell a story. And experienced traders are exceptional story readers. There it is. A setup he has been waiting for all morning. This is where most people make their first mistake. They feel the excitement, the dopamine hit of a potential win, and they act too fast. Our trader does something different. He pauses. 3 seconds. That's all. And in those 3 seconds, he runs through his checklist. Is the trend in my favor? Check. Is my risk to reward at least 1 to 3? Check. Is my stop loss defined before I enter? Check. That last one, the stop loss, is the most important rule in trading. A stop loss is a predetermined exit point. It tells the market, if I am wrong, take me out at this price. It is the difference between a bad trade and a catastrophic one. Most failed traders don't lose because they are bad at analysis. They lose because they refuse to take the stop loss. He enters the trade, 500 shares, entry at 47.20, stop at 46.80, target at 48.60. And now, the hardest part of trading begins. Waiting. The position is open. The risk is real. And every tick of the chart tests your conviction. Here's the psychological paradox of trading. The moment you enter a position, your brain immediately starts working against you. It looks for reasons the trade is wrong. It amplifies every red candle and dismisses every green one. This is called loss aversion. Studies by Kahneman and Tversky, the founders of behavioral economics, showed that losses feel twice as painful as equivalent gains feel good. Losing $100 hurts twice as much as winning $100 feels great. That asymmetry is what destroys most trading accounts. The stock hits his target, exactly where he said it would go. He closes the position. $700 profit. Does he celebrate? No. He opens his trading journal and writes 3 sentences. What went right? What he could have done better? And whether he followed his plan. That journal, that discipline, is worth more than any single winning trade. Here is the uncomfortable truth about stock market trading. The technical analysis, the charts, the indicators, the patterns, accounts for maybe 30% of long-term success. The other 70%. Psychology. Can you sit through a drawdown without panic selling? Can you take a loss and come back tomorrow without revenge trading? Can you follow your rules when every emotion is screaming at you to break them? The biggest account killers are not bad trades. They are revenge trades. A trader loses $500 on a bad setup and immediately tries to make it back with a bigger, riskier position. That is revenge trading. And it is how good traders blow up their accounts. Our trader has a rule. If he loses 1% of his account in a single day, he stops trading. Not because he's giving up, but because he knows that trading while emotional is not trading. It's gambling, the lunch hour. Most professional traders reduce their activity between noon and 2. The market becomes thin, spreads widen, moves become random. The pros learn this the hard way. The amateurs learn it with their account balance. The afternoon session begins. Volume starts picking up again. Institutional traders, the big funds, start repositioning for the close. Here is something Wall Street doesn't advertise. The top 10% of traders don't try to beat the market every day. They look for 3 to 5 high-quality setups per week, and they miss most of the market's moves on purpose. Patience is not passive. It is the most active skill in trading. 15 minutes to close. This is the second most volatile period of the trading day. Funds are closing positions. Algorithms are rebalancing. Retail traders are panicking. Our trader has one open position from the afternoon. It's up $340. This is one of the oldest debates in trading. Let your winners run, or lock in profits before the close. Our trader has a rule. He never holds overnight unless the thesis is extremely strong. Because overnight, anything can happen. Earnings reports, Fed announcements, geopolitical events. The market can gap against you by 5% while you sleep. The closing bell. He closes his afternoon position. $340 profit. Total for the day, $1,040. But here's the number that actually matters. Not $1,040. His win rate this month, 58%. His average winner, 680. His average loser, 290. That ratio, winning more than you lose per trade, even with less than 60% accuracy, is the actual formula for sustainable trading. Not prediction, not certainty. Math. Now let's talk about the reality that trading influencers won't show you. 80% of retail traders lose money in their first year. Not because trading is impossible, but because they start with unrealistic expectations. They see Instagram traders showing 500% monthly returns, and they think that is normal. It is not normal. A professional trader making 20 to 30% annual return is exceptional, consistently. The traders who last, the 20% who are consistently profitable, have 3 things in common. 1, they treat every trade as a probability, not a certainty. 2, they obsess over risk management, not returns. 3, they keep a journal and review every single trade. That's it. No secret strategy, no special indicator, process, discipline, time. The trader's day ends, not at the closing bell, but 90 minutes later, after he has reviewed every trade, written in his journal, identified the one thing he will do differently tomorrow, and then he closes the laptop, because the market will be there tomorrow. And so will he. The stock market is not a casino. It is not a lottery, and it is not a shortcut to getting rich. It is a game of probabilities, played by humans with emotions, against other humans with emotions, and the player who controls their emotions the best wins the most. Whether you ever trade or not, the psychology of this world applies to every decision you make with money. Loss aversion, confirmation bias, revenge spending. These are not trader problems. They are human problems.